Welcome to another video lecture. This lecture is on business valuation in the financial management paper. Business valuation is all about valuing a company. Why do you need to know how to value a company? If you're making a bid for another company, it is important that you, the buyer, are able to create a range of values within which you are prepared to negotiate the price to pay. Equally, the one who is selling or who is floating a company, the seller of the company, must also create a range of values within which to negotiate. It doesn't mean that because a seller has pegged the price for a company at a certain amount, then that's the amount which the buyer will be prepared to pay. So both parties should have a range of values in which they are willing to negotiate, or in which will help them in their negotiations. This range of values could range from a maximum to the minimum value of a company. The maximum values are usually obtained from the cash flows or earnings under new ownership, followed by the value by valuing the dividends under the existing management, and lastly by calculating the values of the assets on the assumption that you are starting the business from scratch or you are breaking up the business. We'll now go through the different valuation methods. The first valuation method, which is usually straightforward, is the market capitalization. The market capitalization is a market value of a company's shares, which you compute by simply multiplying the market price of the shares times the number of issued shares. The questions will always give you the market price of the shares. The second valuation method is the asset basis, which is also called the net asset value basis, or NAV. If a business is difficult to sell, its owners may be prepared to accept a minimum bid that match the value that they would get from a liquidation. So there are two ways of assessing this. You use the values on the statement of financial position. However, you should remember that the values on the statement of financial position are book values, and these may differ from the market values. So the examiner will give you the market values, will also give you the book values. So in making your calculation, substitute the book values with the market values, unless where you are not given any market values, then you can use the book values. You could also use the realizable values, though this one is harder to calculate. But if a company can assess the replacement values of the asset, it can work out the cost of setting up the company from scratch without an acquisition. The asset basis has got some disadvantages. One of these disadvantages is that this method ignores intangible assets as well as future profits. In using this method, please take note of the following formula. The value of the company will be calculated as total non-current assets minus all liabilities. Total non-current assets, the total tangible assets, total tangible assets plus current assets, total tangible assets plus current assets minus all liabilities. This is an important formula for you to remember under the asset basis method of valuation. We move to the third one, the dividend basis. Using the dividend basis, the value of a share is calculated as the present value of the future dividends being generated by the existing management team. This one is more relevant for minority shareholders. In the FM paper, you'll be given the formula. This formula, which is PO equals DO, open brackets 1 plus G, close brackets, over RE minus G. DO being the dividends paid now, RE, sometimes abbreviated as KE, is the cost of equity of the target. G is the growth rate in dividends. You may have to calculate G. There are two methods of calculating G. You have the historical growth method, which is given by G equals open brackets D1 over DO, close brackets, to the power 1 over N minus G. G equals open brackets D1 over DO, close brackets, to the power 1 minus N, then everything minus 1. You also have the Gordon growth method, which is BR, where B stands for the proportion of earnings reinvested, R standing for return on investment. So you may have to calculate G to use in this formula. The disadvantages of the dividend basis is that it is difficult to estimate future dividend growth. Second is that it is inaccurate to assume that growth will be constant. While you are using a series of dividends over a period of time, the assumption all the time is that G is constant, so you only have one G. The third disadvantage is that it creates zero values for zero dividend companies, since you are unable to compute the value of the company with a zero dividend. But that doesn't necessarily mean that that company has got a zero value. fourth disadvantage is that it creates negative values for high growth companies. For example, where the growth is higher than the RE, the cost. The next valuation method is the earnings basis method of valuation, which is given by the formula market value equals PE ratio times earnings. The PE shows the market's view of the growth prospects and risks of the company. The earnings show the current profitability of the company. The only thing with this valuation method is that it's used for companies which are listed on the stock exchange. So for those companies who are not listed on the stock exchange, you have to use a proxy company P ratio. A proxy company will be a company which is listed on the stock exchange but within the same industry as your company, which is not listed. But you have to remember that a company which is listed is more superior than one which is not listed. So you may need to adjust the P ratio to take into account the risk factor of the non-listed company. The next valuation method, we're still on the earnings basis. We look at the disadvantage. Okay, we already said that the P ratio is for those companies, only companies who are listed will have a P ratio. So which P ratio to use, again, could be a challenge, because even though you may use a proxy P ratio, the capital structure, it's very difficult to find a company, two companies with similar capital structure, two companies with similar management styles. So that creates a problem when using a proxy P ratio. The earnings, on the other hand, can also be affected by one-off transactions where, for example, an entity sold an asset in one particular year, and that asset, there was no asset sold in another year. So there are other aspects which may affect the earnings. So again, this would cause problems in using this ratio. The next valuation method is the earnings yield method. Like we said, both the seller and the buyer of a company needs to have a range of values. Hence all these different valuation methods. And all these different valuation methods will give you different values. So it all depends on what you are looking at, you as a buyer, and what you are looking for, you as a seller. So we continue with the earnings yield, which is given as earnings yield equals EPS, or earnings per share, divided by market price per share. So since we want the market price per share, we'll have to make the market price per share the subject of the formula. When we do that, The formula changes to market value equals earnings divided by earnings yield. Market value equals earnings divided by earnings yield. We move to the last valuation method, discounted cash flow basis. With this method, the value of a share is calculated as the present value of the future cash flows that will be generated by the new management team. So it includes forecast of synergies. Synergies simply means that when these two companies are combined, they will be worth much more than them being separate companies. There will be different synergies. Some examples of synergies which could be generated will be the savings in terms of personnel. These two companies may have each a finance director, may have each a marketing director, or a personnel, two personnel departments. When they merge, they will not need two personnel departments. They may not need two finance directors. They may not need two marketing directors. So some of those positions have to be scrapped and people have to be let go. So the savings as a result of that merger will be what we call the synergies. The steps in this method of valuation are as follows. In step 1, you estimate the cash flows that will be obtained from each year from the acquired company. The cash flows may be estimated for a maximum number of years, say 10 years. Alternatively, there may be assumptions about annual cash flows from the business into perpetuity. Step 2 is to discount these cash flows at an appropriate cost of capital. The cost of capital that is used should be consistent with the cash flow estimate. This means that one or two approaches may be required. You should establish from the question, the information given, whether you need to use approach 1 or you need to use approach 2. The questions will rarely tell you that use approach 1 or use approach 2. The key will be in the discount rate that you are using. If your question has given you the weighted average cost of capital or just the cost of capital, then you know it's approach 2. If the company has given you the cost of equity, that will be approach 1. So in approach 1, you use cash flows after interest payments and after tax. Approach 1, you use cash flows after interest payments and after tax. Those are the cash flows that you want to discount. You discount these with the cost of equity. What you get after discounting, which will be the present value, that will be the value of the company. Approach 2, you use cash flows before interest and after tax. you use cash flows before interest and after tax. So these will represent the returns to ordinary shareholders and also the debt holders. You discount these using the WACC to get the present value of the company for both the ordinary shares plus debt. After you have discounted, then if the question is asking you the value of the ordinary shareholders, then you subtract the debt from the present value. What remains will be the value of equity. So you subtract the debt from the present value, so that what remains will be the value of equity. We can also use the discounted cash flows to value other securities. So the discounted cash flow techniques can also be used to value irredeemable debt, can be used to value redeemable debt, convertible debt, and preference shares. You should note that the cash flows and the required yield should both be pre-tax. The cash flows and the required yield should both be pre-tax in valuing other securities. Finally, we look at an example. We've got a lecture example here. You are given share prices in 3 years' time. You are given lecture example. Grody has 7% bonds which are redeemable at their par value of $100 in 3 years' time. Alternatively, each bond can be converted into 25 shares in 3 years' time. The share price is currently $4.50 and is expected to grow at 5% per annum. Grody's bond has a yield of 6%. You are required to calculate the market value of this convertible bond. B, calculate the floor value, that is its value if the bond was not converted into shares. And C, calculate the value of the 7% bond if it had been irredeemable. So start with A, the market value of the convertible bond. Since it's a convertible bond, it's not always that it may be converted. The holders may choose to redeem the bond upon maturity, or they may choose to convert the bond. So we need to compute the conversion value and compare the conversion value with the redemption value. The current share price is $4.50 and it's expected to grow at 5% per annum. The bond will be redeemable in 3 years' time, so we grow the $4.50 by the 5% growth for 3 years to give us the share price in 3 years time of 5.21. To be converted into 25 shares, so 25 shares times 5.21 gives us a conversion value of 130.25. Since the conversion value is higher than the redemption value which is given as 100, the par value, so it means the holders would prefer to convert, since it's more beneficial if conversion was to take place. Since the conversion value is higher than the redemption value, then the value in the last year, the redemption value will be replaced with the conversion value, and the redemption period will be replaced with the conversion period. So the conversion value will be 130.27 plus 7 interest in the last year, since in the last year we discount both the interest and the principal. In the first 2 years we only discount the interest, the 7, and then 137.25 in the last year. So the present value of conversion is $128.1. So that is the value of this convertible bond. We move to B. Calculate the floor price, that is if the bond was not converted. So if the floor price, that is if the bond was not converted, it's simply the interest. In the last year we don't use the conversion value, we use the par value or the redemption value of 100 plus the interest. So the interest still remains the same, 7. What will only change is the last year, 107. So the value, if not converted, or the floor price is 102.7. Requirement 3, calculate the value of the 7% bond if it had been irredeemable. If it had been irredeemable. Let me point out something. There's a difference between redeemable and irredeemable. You will have covered these terminologies under cost of capital, but just in case you have not covered or you have forgotten, when a bond is redeemable, to calculate its value or its cost, we use a calculation which is similar to the IRR. For the cost, we actually compute the IRR. The IRR, the internal rate of return, is the cost of redeemable bonds. The value, on the other hand, the calculation is similar. The only difference is that you don't have year 0. You don't include year 0, but you still discount the interest over the duration and the principal in the last year. What would distinguish it from the costs of the bond calculation is that in the cost you've got year 0, in the value there's no year 0. So pay attention with the terminology. You need to identify these two words, redeemable and irredeemable. That would tell you what type of calculation which you need to do. So we move to see the value of the bond if it was irredeemable. It's simply the interest times so we simply discount the interest in perpetuity. The perpetuity formula is 1 divided by R. Our discount rate, we're given as 6%. The interest is $7. So you discount $7 divided by 1. $7 times 1 divided by 0.06 gives you $116.7 as the value of the irredeemable bond. That brings us to the end of business valuation. Now you need to consolidate on the knowledge by looking at different questions. So the revision kit has got a lot of questions under business valuation. Do find time to practice those. Thank you for listening, and we'll catch you in the next video.